Hey, Greg and Paula, it's Max. I want to share with you the information, the market analysis I did on Jackson Gap. I sent all of these comps to Paula earlier this morning, and these numbers are just from those exact comps, that exact same group of comps. I just organized them into a little bit of spreadsheet to try and do a little bit more in-depth analysis. These numbers are from the last 90 days. I don't think that the next 90 days are going to be as good as the last 90 days. I think that we have started to turn the market. These comps are very good comps. You can see how they compare to Jackson Gap. Here's the average of these. It's two. It's not a big group, but they're very close to Jackson Gap as far as how they compare in above grade square footage and total square footage and finished square footage. They're very good comps. The active numbers are averaging at 632. The under contract, and these are not the actual contract prices. These were what they were asking at the time of contract. We can look at the days on the market and see, not see, but guess how far they came off of their asking price in 7, 11, or a month. So probably not a lot, but I would imagine that on average they came down some. And these are sold within the last 90 days. And I didn't even average that because one was on the market forever and one was on the market for a very short time. So these numbers are for homeowners. People that buy a house to live in are always going to spend more money than an investor. So I'm just looking at these saying these guys are homeowners, most likely not investors. And I'll do the investment analysis later. So I'm just going to skip through this. You can look at the averages and see how they compare to Jackson Gap. All of these are really good comps geographically and structurally, good comparable homes. Again, I sent this information to Paula earlier today. This is the investment analysis. Now, there's lots and lots of different ways to finance an investment. I'm just going to go over two of them. One of them is to throw all your cash at it. So here's this property nets annually $27,073, and at a price of $625, which based on what I just saw, I don't think that an investor would pay, and you can see why they're not going to pay that because the numbers don't make sense. The cap rate is, you could think of it as a return on your money. The annual return is 4.3%, and investors are looking for 7% or higher in real estate investments. If they did some financing and they put as little of money as they could into the investment, and still bought it at that $625 purchase price, they would have this size of a loan. And I calculated it at 3% for 30 years, and it's right around $2,000 a month for the payment on that loan, the principal and interest. And so that brings down the return. The net on the investment is $3,261 a year. So if you said, let's look at the return on their investment. So this is going to be a minimum amount of money into the investment. For non-owner occupants, you're looking at 25%. So for a $156,000 investment, that's about a 2% return. So you can see that that purchase price of $625 doesn't make sense. Now, I realize that we can change these numbers and do an interest-only loan, do an ARM, and bring down this 3% annual interest rate. But people aren't willing to do those, what you might say, creative, or other people might call risky loans in this current market. When people are willing to do an interest-only loan or maybe an ARM, they're looking to get into a market that they think is going to appreciate. And I don't think that's the case with our current market. People aren't saying, hey, I want to buy a house. I got to get in here because I see great potential appreciation in this number here, the purchase price. That's not the case right now. So yes, we could finagle and do some loan adjustments, but it's not going to bring up the number that greatly. And it's also we're not even looking at, we're just looking at the return on investment. We're not looking at overall appreciation of the investment, and that's people are thinking we're at the top right now. So that's it. It's not looking good. I just want to be frank. I want to. Maybe I'm getting a little bit defensive here, but when I got the call that you wanted to sell your house within less than a year of owning it, I remember saying, I would never recommend that somebody do that, but that wasn't an option at that point. I know that you were very unhappy in that house, and your happiness is paramount. So that wasn't recommended, but it wasn't an option. And then when you took Jackson Gap off the market, I also didn't recommend that. It was taken off the market to wait for a better market. Again, appreciation to sell it, and not as much competition with the builders. Didn't recommend that at the time because I felt like we were in 10 years of appreciation and we were soon to come down. Now, I never predicted this COVID thing, but I think one way or another the market was going to turn in the next, right about now. So anyway, that's my defensiveness about this. And I think I'll just be frank and just say, I think you're going to lose money on this, and if you decide to sell. And I think that it's going to be how much, and I believe that the longer you wait to sell, in the next 3 to 5 years, would be the more money potentially to be lost.